Here's a good question. Could investing in money-losing, yes, money-losing companies be the key to making money for your portfolio? Welcome to Trading Nation. I'm Brian Sullivan. We're joined by Chad Morganlander, portfolio manager of Stifel Nicolaus, and Brian Lund, portfolio manager of the small cap fund at ClearBridge Investments. And Brian, this is kind of your thesis. I'll ask you to just sort of walk us through your methodology because it sounds a little odd. Money-losing companies. Give us some names and we'll have Chad respond.
Yeah, I mean, the fact is that the Russell 2000 index, which is our benchmark, has more money-losing companies now than it has in a long time. That's kind of the result of the number of companies shrinking, a lot of public venture capital, et cetera. So we have to deal with money-losing companies. Our approach is to try to tease out from the market price exactly what the expectations are among investors for returns on capital, investments, growth, et cetera, for the company, and then using our own competitive strategy work, try to figure out how our expectations are different. And we tend to find that in a lot of cases, it's our time frame, our long-term investment horizon that makes us find things that the market is underpricing.
Okay, and so what have you found? I know there's companies like HighCrush. How do you uncover these companies?
Yeah, I mean, the companies generally fall into a few buckets. Some are investing for future growth, some are startups, and some are cyclically depressed. So you mentioned HighCrush. That's a company, they make sand for fracking operations. They have very high quality sand. It's in a low-cost area. They have good transportation costs, but demand for the sand has been down as the number of rigs in land fracking operations has come off in the last few years. We're starting to see that come back. So though HighCrush is losing money now, pricing is getting better. They're getting better fixed cost scaling on their mines. So we think they're going to end up earning a lot more money in the future. They earned as much as $3 just a couple of years ago, and it's trading under 20. So we think that's going to come back. Another kind of example is one that's investing for the future, investing in projects that are very highly value creative but are money losing at the moment, and that is 2U. 2U is an online platform for graduate education for Tier 1 universities. So this is not online education. It is a platform and a partner to schools like the University of North Carolina, Syracuse, NYU, top name universities in business programs, nursing programs, et cetera. When they win a contract, they have high startup costs. They have to design the platform, they have to design the program, they have to do the marketing to get the students in. But once they're in and they're running over the course of the 10-year contract, they're making 60% of the tuition dollars to get an equivalent degree to a UNC business on-campus degree. So it's a great value for the students, it's a great value for the college, and it's a great value for 2U, but their profits are being masked now because they are winning so many programs. And the more programs they win, the more money they lose, but the more valuable they are.
Okay, and the other pick is Ironwood Pharma. We're not going to have time to get to that one in depth. We got HighCrush, 2U, Ironwood. Chad Morganlander, you're a value guy. You're a value investor, long-term holder. Do any of these names make any sense to you from a value perspective?
So being that I'm a free cash flow guy, this would not be opportunities for my portfolio. But with that said, there's something critical that Brian is mentioning. Companies that have high return on invested capital and they're masked their profitability by reinvesting back into their business. And as a value person, I could see opportunities with those type of companies. For example, people were complaining that Amazon wasn't earning any money and for about 10 years. And the reality is that they were. It's just that they were reinvesting back into their business, a high return on invested capital. By deploying that capital, you had a tremendous amount of growth and a tremendous amount of shareholder value. So Brian has got a unique opportunity with his fund because what he's doing is he's going to try to create alpha in a seam of opportunities, small caps, that are really undiscovered gems. So although I don't follow those three companies, I would strongly recommend investors look at a fund manager like Brian to try to create that alpha over a long run. But keep in mind there's going to be a tremendous amount of volatility.
Yeah, we can't take investing back in the business to be a bad thing. I mean, sometimes Phil Knight of Nike did it for 10 years, didn't pay himself a salary every dime, went back in that business, and we see where they are now. Brian Lund, really interesting thesis, some really interesting names. We appreciate you bringing them to us here on Trading Nation. Thank you. Chad, as always, thank
My
you.
pleasure. Happy holidays.
Happy holidays as well, Chad. Thank you. Happy holidays to you as well. We appreciate your insight. Thank you for watching Trading Nation. I'm Brian Sullivan, and we will see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.